In value investing, investors seek to find stocks that are underpriced or undervalued. But what does that actually mean? Two popular measures for determining if a stock is undervalued are price to book and price to earnings. Price to book refers to the price of a share divided by the book value per share. The book value of a company is the value of the tangible assets that a company holds, such as factories and buildings, minus liabilities that a company might have. Price to earnings refers to the price of the share divided by the earnings per share. The earnings of the company refers to the profit that the company makes, usually reported quarterly. For both these ratios, we expect a negative relationship to value, where the lower the ratio, the more likely the company is to be undervalued. A lower ratio means you would have to pay less for the same unit of book value or profitability. We would thus expect companies with lower ratios to be more worth buying than those with high ratios. But how well does this actually play out in practice? Let's test it out. The first strategy we can try is one that was tested out in the 1970s. In 1977, Basu published a paper titled Investment Performance of Common Stocks in relation to their price-earnings ratios, a test of the efficient market hypothesis. In that paper, he observed that a portfolio constructed by selecting stocks with high PE ratios had an average annual rate of return of 9%. A portfolio constructed by selecting stocks with low PE, on the other hand, had an average annual rate of return of 16%, suggesting that a low PE yielded higher returns. Since then, others have also shown similar results for the PB ratio. However, how robust is this strategy? Let's look at performance within the NASDAQ 100 in the past 15 years. We adopt a similar methodology. For every year, we first create 5 buckets of equal size. We place stocks with the lowest PB for that year in the lowest bucket, and stocks with the highest PB in the highest bucket. We do this for every year starting from 2005 and observe the 5-year returns of the respective buckets. We expect that the lowest bucket will have the highest return, while the highest bucket has the lowest return. Interestingly, we see a completely opposite trend for the NASDAQ 100, with the highest PB bucket actually having the highest return. When it comes to PE, the story is even less clear, with a non-linear relationship found. There are, of course, several reasons why this could be. For one, the NASDAQ 100 tends to be tech-heavy, and tech or software companies might not be particularly asset-heavy. Next, let's see what happens when we buy stocks when the ratio dips below a threshold. In 2012, Micron recorded an average price-to-book ratio of 0.77. This is below a threshold of 1, which is popularly seen as an indicator for when a company is undervalued, since the book value exceeds the amount it's traded for. At the start of 2013, Micron was trading at $6.63. At the start of 2016, 3 years later, it had jumped to 14.16 for a 114% return. This gives us a single data point of a company that was below the threshold and had a 114% gain over 3 years. If we repeat this analysis over the NASDAQ 100 companies, however, the trend is less clear. While it is true that the worst performing company was above the threshold, there were many other companies that were above the threshold and that performed well, even beating the companies below the threshold. We can perform the same analysis for price to earnings. In 2008, Micron had an average PE of 11.5, below a threshold of 15, which is about the PE for the S&P 500. At the start of 2009, it traded for $2.83, and 3 years later it traded for 6.28, a 121% return. Again, we get a single data point. However, after repeating across the NASDAQ 100, we see that the threshold does not provide clear separability between stocks that have high returns versus those that don't. The third strategy is to buy stocks that have ratios lower than their historical mean. In 2008, Apple had an average price to book of 4.8. In April the following year, it released its earnings report, posting a PB of 3.3, 32% lower than the previous year. At that time, it had a price of 3.34. At the end of the year, that had risen to 6.48, for a 94% return. This presents a single observation of a company that had a 94% gain in price after its first earning report, when its PB ratio was 32% lower than the historical ratio. If we do this across multiple years, however, we see again that the trend is not consistent. In particular, the year that Apple exhibited its highest gain, it actually had a PB ratio 20% higher than historical average. In general, we expect a negative slope. Looking at the trends across the NASDAQ 100, we see that this is true for about 70% of the companies, such as Facebook, but is generally a noisy signal, with companies like Netflix exhibiting an upward trend. Let's now do the same for the PE ratio. In 2008, Apple had an average price to earnings of 75.5. In April the following year, it reported a PE of 53.3, 29% lower. As before, the return at the end of the year was 94%, giving us a single data point of a 94% return after a 29% lower PE ratio. Again, however, if we look across multiple years, this is not a consistent trend. If we look across the NASDAQ 100, we again find that there is no consistent downward trend as we would expect. Lastly, let's see what happens when we buy stocks with ratios lower than the sector average. Returning to the same case of Apple in 2008, we can also look at stocks in the same technology sector that year and calculate the average price to book for that sector. In 2008, that was 3.8. We see that Apple had a 13% lower PB in April 2009, as before the gain at the end of the year was 94%. We repeat the same analysis as before and again see that there is no clear downward slope as we'd expect. Doing this across the NASDAQ 100, we again see that while 70% of tickers have a downward trend, it is often noisy. We can also look at trends per sector. For example, here is a plot for the technology sector. While there is a slight downward trend, the slope is not steep enough to be significant. Other sectors also do not perform much better. Let's see how comparing PE to sector averages does. Again, we can compare Apple's price to earnings in April 2009 with the sector average of 79.9. We see that it had a 33% lower PE ratio, with a 94% gain in stock price at the end of the year. Looking across the years, we do see a downward trend. However, the points are very noisily distributed. Looking across the NASDAQ 100, we can see that there are several instances where there is actually an upward trend. Let's also look at the analysis by sector. We see again that the trend for technology is fairly weak, with a very slight negative slope. Many stocks that are well below the historical PE perform poorly. This is true across different sectors. Of course, there are many other variations of strategies we could try, including using different time windows, and also comparing against correlated stocks, or the broader market as a whole. One key takeaway, however, is that these ratios only tell part of the story. Price to book, in particular, does not work well for companies which are not asset heavy, such as many technology or software companies. Performance may also differ depending on the market cap of the company. These signals should be used in the context of a broader set of signals, instead of in isolation. If you'd like to see more variations of strategies and indicators put to the test, don't forget to subscribe to be notified for future videos.